What are investor expectations moving forward, and how do those compare with the expectations of professionals? What does a recent study show about financial lessons learned from the pandemic, based on a survey of many investors? And how is the Fed changing its plans? We'll talk about that and more today in the second quarter of 2021 quarterly context webinar for friends and clients of the advisory group. I'm Greg Patterson, CEO, and for those of you not familiar with the advisory group, we are a wealth and life strategy firm focused on helping business owners and leaders with their financial and non-financial goals in the realms of personal and family, their fiduciary, employee support efforts, and their communities through their foundations and endowments they might be involved with. To complement the strategic work we do with clients, our quarterly context webinars are designed to make economic and other information approachable, some high-level perspective regarding the economy, markets, and investor behavior patterns, and more to help our personal wealth and institutional clients stay more relaxed by staying informed and therefore to make better decisions relative to your goals. The first section is mostly high level. Section 2 has some additional detail for those that are interested. And we'll try to keep this to 20 minutes or a little over. And we'll also circulate a video link should you like to view some part of it again or pass it on to someone you know that you think we can help like we've helped you. And if you have any questions, please go ahead and submit them to the question box and we'll answer those as we go along or at the end. As always, we like to start with a quick review of and reminder of the idea of focusing on goals rather than some of the less relevant daily things in the news that can occur and can throw people off track in terms of their focus. So the key part to focus there is the intersection between things that matter and the things that you can control. For example, you can't control markets, but you can control what your stock bond mix is, your risk profile, your investor behavior, your savings behavior, your goal definition, and so forth. So focus on what you can control. As always, there are a number of news events that occur that cause the market to bounce around a little bit. Some of the more recent factors have been the waning, although recently increase in COVID cases and a bit of a spike in inflation. However, the market has, for the most part, overlooked or ignored rather some of those inflation spikes, thinking that they will be just temporary. Won't walk you through all the details here, but here's some key takeaways in case you'd like to refer back to this. COVID status is been a bumpy improvement over time. Continued large stimulus has influenced both the market and the investor behavior and spending patterns, especially some of the stimulus has hit actual households. Unemployment is improving, continuing to improve, although the labor market is still tricky to navigate. Many people seeking, claiming they want to find work, but still slow to seek jobs. And there's a lot of jobs available out there, and that's creating some interesting dynamics. Inflation, as mentioned, jumped up to 5.4%. That's the highest in 13 years. And that is causing a lot of buzz and discussion around that. And overall, the markets, again, have ignored that, hitting new highs. But we would encourage and remind everyone to know and to remember that risk still exists. By definition, markets are cyclical, and at any point there could be some cooling and some reversals as part of the long-term pattern. In terms of COVID cases, you can see recently numbers have picked up again. These dotted lines show the status at the time we've conducted these quarterly context meetings. And interestingly, there seems to generally be a pickup in cases right around when we do quarterly context. It seems to, which is generally towards the end of the first month of each quarter or a little bit after that. So who knows if there's any explanatory factor there related to overall human behavior, but have picked up globally as the Delta variant has increased speed and spread around the country, with some cases of those who are fully vaccinated contracting the virus, although typically not serious cases. The vast bulk of the serious cases and infections and deaths are amongst those that are unvaccinated. Same overall pattern in the US here, a recent uptick after a pretty seemingly consistent decline. And then in California, more specifically, again, sort of a micro view or a cosm of that same overall pattern. For those of you that recall these heat maps, a lot less red than and deep orange than we saw in previous quarters. So hopefully it will stay that way or go back to that and continue to improve. We've talked about how we were a while ago, we're approaching the first real flu season, a full flu season during the pandemic, went through that without major hiccups. Interesting now, we're only 4 months away from the next flu season, so it'll be interesting to see whether or not the Delta variant has more of an impact in that type of environment. In terms of some of the broader metrics, unemployment, as stated, has continued to improve a bit. Wage growth has picked up, but still not quite where it might be for long-term stimulation, although the trend is there, although some of that may be due to short-term factors and the labor shortage supply, but we'll have to see about that. Inflation still hovering at low levels until recently, and with this, what some are calling a transitory spike, up to about 5.4%. Again, bigger numbers than we've seen in more than a decade. Consumer sentiment has improved and then waned a little bit. And so those are some key general patterns to note. Here's an updated slide of the Fed rates. You can see hovering right at 0%. Really continued all-time lows with there's some ratcheting up pre-COVID and then came right back down to 0. The Fed is broadcasting that they will, just today some news came out that hinting that not clear whether it will be rates, more likely an increase in the reduction of bond buying and possibly moving up the dates where bond selling would occur as part of the Fed's stimulus program. Rates are currently low, and of course that has implications for dry powder in terms of the Fed's ability to help when there is the next financial crisis, and also with low rates as they go up, that tends to have a negative impact on bond returns as yields go up, bond prices go down. In terms of markets, yet another very strong quarter. US market up 8%, that's above the full year projected return. International just a little bit below the full year projected return at a little under 6%. Emerging markets 5. Real estate got a bit of a boost this quarter despite some of the COVID residual factors at 10%. And bonds, a solid near 2% return, which is above the full projected year return for bonds after a tough quarter, a bit of a bounce back after a tough quarter in the first quarter as rates, market-based rates picked up. For the full year, we can see 30 to 40% returns, about more than 4 or 5 times higher than the projected return. And when that happens, and if that happens for long enough, there's eventually typically some kind of reversion to the mean where returns are cooling. talk about some of the related investor expectations shortly. The four bad bears, the Great Depression in gray, the dot-com crash and recovery in green, the oil and financial crisis of the 70s in red, and the most recent global financial crisis plus the COVID hiccup in blue. These are after inflation returns to get a sense about the real impact on spendable, eatable, as some people say, numbers. And you can see the long-term average, or rather projected returns would be roughly around this dotted line. So the current markets are materially above projections, and over time we would expect that these lines would come closer to meeting, although that could take some time. Part of that could come through some kind of correction, although there's no obvious reason why that would happen immediately, but surprises can happen at any time. And or it could be a kind of a gradual bumpier sideways type return environment, or the market could have some continued positive surprises as we go. Taking a look at what's been a really unusually strong stock market period. If we look since the stock market low in March of 2020, the markets are, as you can see here, across the different US investment styles, from small, mid, or large capitalization stocks across the different value, core, and growth, 90 to almost 140% returns, which is very, very strong. Full 10-year returns, almost 18% for large cap growth, and in the 11 to 13% range for the most part elsewhere here, which is several percent above the projected returns and several percent above the long-term averages. And long-term averages are oftentimes relevant in terms of what the long-term projections might be. So it's important not to get overexcited, as we've talked about before, about some of these recent high returns. The bond yield curve data is shown here a couple of different ways. If we look at the chart here on the right, this gray range represents the 10-year spectrum of where the yield curve has been. You can see back in 2013, the yield curve was hovering here with long-term rates in the 4% range at the longer and longer maturity end of the curve. Recently, as low as the low 1% range at the middle end of 2020, still in the heavy pandemic impact period, and subsequently rates have moved up a little bit, but still hovering pretty close to 2%. So still quite a ways to go to get back to more normal higher returns. And when there is a yield curve that looks like this and has a slower rebound back to a normal environment, that oftentimes suggests lower long-term growth expectations. The organization at Texas conducted a study of over 8,000 affluent investors, and here we can see a few lessons that investors claim they learned, points that might not be a surprise to anyone, but are still nonetheless, it's interesting to see what people say, and if there are areas where you haven't fully executed on some of these things yourself, it may form a helpful checklist. So in the general personal finance area, keeping spending reasonable relative to earning, having an emergency savings account. Interesting ways to think about how much should be in a savings account, by the way, for emergency savings. estate planning, and understanding the role people play in their overall family, household finances. In terms of investing, avoiding emotional investment decisions. This is a topic we address regularly in quarterly context with some interesting studies with more detail. So around the idea that sometimes people get overexcited when markets are strong and then overly nervous when markets go down. So that's not surprising that that is at least in the broad investor community, a top item there. Understanding risk in the portfolio, and also important to mention that investment risk is only one of an array of risks, and investment risk is one of the only risks that actually has a reward. So it's key. The term here is understanding risk in the portfolio, not avoiding risk, because avoiding risk in a portfolio can mean dramatically increasing other more damaging risks outside of the portfolio. Rebalancing, of course, which is very important, and weighing the tax consequences. And for those that are clients with taxable assets, understanding how tax efficiency can be helpful in that regard. More data, plus some data from our end, some more data here from the Natixis study, and some of which is really interesting and relates back to the comment earlier about investor expectations. The recent markets have really led the average investor to have significantly higher expectations moving forward in the long term about what stock markets will do. So I'm going to start from the bottom here. The Callan 10-year projected returns that we rely on for some of our planning and modeling, it projects a return of 6.9% before inflation. Callan long-term numbers farther out, 30 years or so, just under 8%. The global financial professionals on average project 7.3% for long-term. It's not 100% clear what time frame that is in the study, but probably in the 20+ year range. The average return of the S&P going back almost 100 years is 10.2%, but the average global investor expects returns of 16.5 or almost 17, and almost 20% for affluent US investors. So that's double the long-term average, and about 3 times what the the projections are on average for the next 10 years. So this is actually a dilemma because if people are using this type of excessively high number in planning, it would cause them potentially to dramatically undersave and underprepare, because if actual returns are closer to just even the long-term averages, let alone some of the more dampened medium-term returns, that creates a planning and decision challenge and gap, and that kind of aggressive assumption can lead to some real problems. So important to manage expectations. On the right here, we can see not the long-term returns, but the average investor 1-year projection for the year shown. And you can see how, as the stock markets in the last 10 years or so have continued to produce surprisingly high returns, partly based on this huge wall of government stimulus, the return expectations of the average investor have gradually gone up and then jumped up more recently. And what's interesting there is 13% expected for 2021. That could happen, but it's certainly not reasonable to have a 20% expected return per year for the long term. company earnings simply can't support that. That's just, for a whole array of reasons, is simply not reasonable or possible. On a somewhat more indirectly related note, for the asset class corner here, you can see how for the same level of real or after inflation return of 5%, how portfolios have had to change given that capital market expectation and expected returns over the last several decades have actually come down. Some would wonder why that happens. Why are projections down sort of incrementally over the last number of decades? And the simplest explanation is that the economy is really waiting for the next major and systematically incorporatable impact on productivity. So there was, for example, the Industrial Revolution, the PC revolution, the smartphone revolution, which may be a subset of the PC revolution, things that caused increased productivity, and there's nothing obvious on the horizon. Some would say that artificial intelligence might be that element, but there are also increased concerns about the degree to which that would impact the labor market in ways that could offset some of the potential benefits in terms of job losses. However, people thought the same thing about a century ago, when about half of the jobs in the US were in agriculture, and then just a few years later it went down to 5 or 10%, but there was huge growth in other areas of the economy and jobs were created elsewhere. But the point being here is that the amount of risk that has been required to maintain the same level of projected return has gone up about 3 times. So this is something that investors need to be aware of and recognize. If you have the mentality that risk should be the same, or in your mind that it is the same relative to how it was 2 decades ago, volatility is expected to be higher and has been higher in more recent years. Although in the last number of years there have been some hiccups along the way, but for the most part the last 10 years have been unusually low volatility, but that doesn't mean that volatility is permanently gone. In terms of the 401k corner, can quickly see for the most part here what that a number of plan sponsors have added and increased over time. The incorporation of a Roth option, of automatic enrollment, automatic increases in contribution rates and so forth. So some interesting data, and feel free to reach out to us if you're a client or not a client and would like to see more of this study and discuss some of these dynamics in terms of how it might impact you and your goals regarding your plan participants. In terms of the rules and regulations section, no material updates in the personal wealth area or foundations and endowments, although we would encourage foundations and endowments to update spending policy if you have not already done so this year, just to ensure sustainable spending planning. In terms of retirement plans, the Department of Labor came out with cybersecurity guidance for plan sponsors, providers, and participants, and this link here will give you access to some one-pagers that you may find helpful in that regard to ensure that you're complying effectively with that. And the IRS also lengthened its exception for physical presence related to some procedures in the COVID era. In terms of our blog, you may have already read some or all of these posts, but in case you haven't, just a little summary of what's available there recently. A piece about design thinking and other ways to help achieve big goals. Topic on inflation and investments. 6 exercises to stress test your midlife gap year if you're considering taking a professional or personal break. There's a few of us at the advisory group have been invited to attend podcasts and were interviewed, and one of them, or a couple of them have been posted there. 4 key steps to get ready if you're thinking about selling your business in terms of planning for that, and then how to take a break and still be fiscally and financially responsible. So thank you for, we'll be moving on to the second section in a moment, but for those that are dropping off, thank you for attending today. We always hope you feel well supported. If there's anything we can do to support you better, please let us know. And we really value that feedback. We want to continuously improve to support you as best we can. So we'll whip through a few extra charts here for section 2, where we are in the business cycle. Different opinions about that, but clearly not in the recession stage anymore. The official notes about the recession were that it ended in April 2020 after only 2 months, based on how the definition of recessions is calculated. So that was the shortest recession on record. Stock valuations should not be surprising, given what we've talked about before about the long pattern of excessively strong returns in recent years. Valuations are relatively high compared to history. These are relative to 10 years here across different asset classes. Over 25 years here relative to different major countries and regions. And here in terms of the PE, price earnings ratio, you can see this is now ratcheted back up to a level that we haven't seen since 2000. That's not to suggest that we are in the same environment of the dot-com. Many of the companies now actually do have earnings and solid business models. That doesn't mean there aren't some risks along the way, because generally once when PE ratios have hit and sustained a higher level for a while, there's usually some level of cooling, although how dramatic the cooling is impossible to predict. You can see volatility has cooled down after the COVID peak, of course, but still has remained at slightly elevated levels relative to the last number of years. And this is actually more normal levels of volatility in the last year. In terms of consumer and other types of debt, you can see household debt service ratio is way down. In fact, the credit cards, personal credit cards, have been getting paid off at levels we haven't seen in a long time, and that's actually good for the economy generally, good for reducing people's debt service, and for an indication of the potential to save more. However, that can be a tricky issue for banks who issue those credit cards, so that can impact those balance sheets, so could impact the stocks and financials. Overall, household worth continues to ramp up, and household net worth, that is, and that is because of both savings, stimulus, 401k balances with the strong market, and the really strong housing market. The quality thermometers and factors here showing that there's been the lowest quality stocks recently have had the worst returns. Higher qualities tend to do a little bit better, and we sprinkle in different quality managers into portfolios with the idea that it can minimize downside risk in difficult markets, at least by a little bit. Investor cash flows have been strong year to date. People who were nervous for a while during COVID seem to have regained their confidence. Our only caution here would be that when the numbers are this consistently strong, sometimes it's also a precursor to some additional volatility when people are throwing a lot of additional money into the market. Interesting to note that a big push into taxable bonds, however, right at a time when the bond markets are expected to be more volatile and have some negative periods along the way. Quick overview, just visually here, of our 5-step process we use for personal wealth and institutional clients: analyze, design, formalize, implement, and monitor. This is both a process that's effective for results and effective for managing risk and for managing portfolios relative to goals, and also for reducing fiduciary liability for fiduciaries. And just a quick shot here for those that want to look at it on your own later, a summary of a number of studies that show that while the people typically think of individual investors as being the most susceptible to emotional investing, fiduciaries are certainly not immune to that, and we congratulate both our personal wealth clients and our institutional fiduciary clients for being disciplined investors. Have had a major impact on your families and your plan participants and your communities as a result. So thank you very much for your time today. We look forward to speaking with you at the next quarterly context, and we'll take some questions here as well. Thank you.